Hi guys, how's it going? My name's Joshua Tharby, Chartered Tax Advisor and founder of JSM Partners, a firm of property specialists, tax accountants and advisors. In this video, I'm just going to run through ATED and why you need to know about it. If you own property in a limited company wrapper that's worth more than £500,000, you absolutely need to know about this. Otherwise, when HMRC catch up with you, there's going to be significant fines and penalties for not getting those returns in. So I've got some slides together here. Okay, so everything that you need to know about ATED. First place, what is ATED? So it's an annual tax envelope dwellings. And what do we mean by this? We're going to start with dwellings. It's basically a dwelling that's valued more than £500,000, £500,000 is caught by this legislation and by this tax. And also to be considered a dwelling, it's basically used or could be used as a dwelling. So any kind of residential property that you're letting out or is capable to be lived in, even if it's not let out, as you will see, is caught under this. Hotels, guest houses, student accommodation doesn't count as a dwelling for the purposes of this tax. Enveloped, what does that mean? And it's basically owned by a non-natural person, so a limited company or a partnership, where any partner is a limited company or a collective investment scheme. Most people watching this, you probably fall under the first two if you've got a hybrid setup with a partnership, or most often a simple limited company. That counts as an envelope, so as a result would be caught by this tax. When is an ATED return filed? And basically it's filed in advance. So it's on or after the 1st of April for the return period from the 1st of April to the 31st of March. That's the tax year it runs for. And you have to pay this tax in advance and file the return in advance as well. So by the 30th of April 2024. And the properties need to be RICS valued every 5 years to determine whether you fall into this £500,000 threshold as to whether you need to be considered and doing returns under ATED. But if you are under ATED, what are the charges? So as you can see, the taxes on this are pretty significant, to be honest. And the purpose of this tax is basically to deter wealthy individuals, especially in London, from buying properties in limited companies and just kind of leaving them empty, as was usually the case. All the rich Russians and the Arabs buying up high-value property in an envelope and getting all the tax advantages that come with that. So you can see here, if you've got a property that's worth between £500,000 and £1 million, the charge of £4,400, 1 million to 2 million, 9,000. I won't run through them all, but you can see gradually it gets very, very expensive for properties worth 20 million or more, or actually it's £287,000 as an annual tax on having that property in a limited company. But the good news here is there are reliefs that are going to basically safeguard this for most people from having to pay this tax. And the two main reliefs are basically if it's being developed or held as stock for resale by a property developer, that's usually the case, or it's held by a property rental business and let out to a third party on a commercial basis. And this is the one where you need to be careful with, because essentially a lot of people might own high value property, and £500,000 now, that's not a lot to be caught under this tax. Many properties anywhere south of Peterborough, really, the south, £500,000 isn't really going to get you much. There's lots of clients that do own property, and quite often it can be a case where they don't even realise that this tax exists, but they might let their property out to their family. They might not let the property out on a commercial basis. It might not be a full market value rent. And when you did that, then actually you wouldn't be eligible for this relief. So you need to make sure that if you are letting your property out on an uncommercial basis, then you know about this relief and you pay the ATED. Or if you are letting it on a commercial basis, then actually you are doing the return as we see. Because although you won't have any tax to pay usually, you do need to file a return. We've seen it through the tribunals where even though there's been no tax to pay, HMRC have still withheld the assessment that actually the returns are due, and as a result they've charged filing penalties, and they're very, very significant, running into the tens of thousands of pounds where they've not been submitted for a number of periods. So if you do have a property that's worth more than £500,000, you absolutely must do an ATED return and basically claim the relief that it's either being held as property development stock or it's been let out on a commercial basis. If you don't do this, you will get yourself in hot water when it comes to HMRC. Any questions or comments, guys, do let me know. Any more tax content, any more tax issues that you're facing, do let me know in the comments. Otherwise, remember to hit that subscribe button. And also, I'd love to hear your guys' feedback on this new format of video where we're mixing in the kind of visual elements with the written slides. I've had a lot of people say that it's been very useful because it allows the content to be delivered a lot clearer. But I'd love to hear how everyone else is taking this content. Do you prefer the slides? Do you prefer the talking at the camera videos? Let me know in the comments. That's all for now, guys. Bye. See you next week.